And the 2022-2024 medium-term expenditure framework fiscal strategy document showed that government revenue from January to May 2021 was at 1.8 trillion naira, a 33.3% shortfall of the budgeted amount. This indicates that the recent rise in crude oil prices has not improved the government's fiscal position. Also, Africa is facing a fast-surging third wave of COVID-19 pandemic with cases spreading more rapidly and projected to soon overtake the peak of the second wave the continent witnessed at the start of 2021. Well, to weigh into some of the implications of this is an investment risk analyst with AfriInvest Asset Management, Babajide Atolabi. Thank you very much, Babajide, for joining us on the program. Good morning.
Good morning. Thank you for having me.
So Nigeria's total debt profile increased to over 33 trillion naira, or about $88 billion as at the end of the first quarter of 2021, while debt to GDP ratio settled at 21.1% in the same period. How troubling is this?
So firstly, it is not unusual for a country like Nigeria to have a high debt profile. And this is because Nigeria is a developing country, and debt is a key component of long-term finance for sustainable development. But for Nigeria, the case is quite worrisome because the pace of growth in our debt profile is quite alarming and could lead to a debt crisis if not properly managed in the interim. So over the years, the major drivers of our debt profile, are weak infrastructure, dwindling government revenues, high public expenditure, and the country's exposure to, external vulnerabilities. And, the situation got worse in 2020 due to the outbreak of the pandemic, which saw Nigeria lose both oil and non-oil revenues. In 2021, we had anticipated an uptick in Nigeria's debt profile because the government's revenue projections were quite low, and for sure expenditure remained elevated. So by default, the government would solely rely on debt to finance its obligations. And lastly, another reason that may have contributed to the uptick in public debt is the effect of the currency devaluation on our external debt. That would have shot up our valuation. And going forward, we expect that debt levels will remain quite sticky due to improved domestic and external conditions.
All right, but with this uptick in our debt profile, where do you expect us to settle at the end of the year?
Going forward, I expect that at March we should get an additional 2 trillion in terms of public debt. And currently the Ministry of Finance has delayed its plans to tap into the international debt market. And that is quite understandable because we know how yields are currently trading in that market. We still expect the government to tap into that market because FX reserves are depleting on a daily basis, and we getting external debt will definitely be a good one to show up our external reserves. In terms of domestic debt, we might see continuous uptick. In the first half of the year, the government has been very, very aggressive in terms of borrowing debt in the local debt market, and going forward, we expect that trend to be sustained over the next 3 to 6 months.
Now, notably, the federal government spent a total of 1.8 trillion naira on debt servicing in the first 5 months of the year. That represents about 98% of the total revenue generated in the same period. How do you interpret this?
Thank you. So the best interpretation to this is that Nigeria is a broke entity living from paycheck to paycheck. And I'm sure you agree with me. A debt service revenue ratio of 98% simply means that the government cannot finance other obligations without resorting to debt financing. And a deep breakdown of that number shows us that the issue continues to be weak revenue inflows. The total revenue inflow during that period was about 1.84 trillion compared to the expected 3.34 trillion that was budgeted for in 2021. And we also observed that the major shortfall was from oil revenue. And so despite the rally we see in the oil market, despite the parts in that market, Nigeria is unable to benefit from that rally materially because the OPEC agreement continues to place a cap on Nigeria's production numbers. On a normal day, Nigeria is able to produce about 2.5 billion barrels a day, but because of this production cap, Nigeria is currently doing about 1.4 million barrels per day, excluding condensate. So Nigeria is still not, enjoying what it should enjoy on a normal day in the oil market. And this brings up the argument of the country's over-reliance on crude oil, which is largely determined by external push and pull factors. And lastly, before I wrap up on this, surprisingly, debt service cost within the period was 1.8 times the value of capital expenditure from January to May 2021. And that simply tells you the level of unsustainability of Nigeria's debt profile. And with this kind of ratio at hand, sustainable growth is not in sight, and even the next level we are expecting is not even assured.
Yes, what are the risk factors you see here for investment?
The risk factors I see here for investment is that before I think the major risk will come from foreign direct investment as well as foreign portfolio investment, because investors like to look at numbers aside from all other factors, and a government that is struggling to pay that is struggling to use all its revenue inflow to pay debt, and then that tells you that the debt sustainability risk is high, and investors might be wary of this. And in terms of FX risks as well, which has dominated the investment climate for a number of months back, investors will be quite worried because inflowing your dollar into Nigeria at this point, you may be a little bit risky because the fact that investors might not be able to get their currency as at when due, and the likelihood of a currency devaluation, which continues to fuel analyst sentiment in past 6 months, that might also contribute to a major risk factors that investment managers might be on the outlook for. So on the large side, the major risk here is Nigeria's debt sustainability risk in line with the foreign currency risk.
Now, is there anything the government could have done differently to avert this debt scenario? And what are the realistic measures that can be put in place to remedy the rising debt profile in order to avoid the Sudan and Greece debt crisis scenario?
Yes, so I think the government may have to handle the issue from both the revenue generation perspective as well as our high public expenditure profile. I mean, the major reason why we borrow so much is because we earn so little and we have a lot of things to cater for. In terms of revenue, the Nigerian government will have to increase the adoption of market-friendly policies that will drive investment in the oil and non-oil sector. Policies that will attract capital flows into the upstream sector. That way we'll be able to drive our production numbers and then we'll increase output. Also, policies that will also enable businesses to thrive in the real sector. And then at the end of the day, these companies will be able to pay more taxes, and then indirectly the government is also getting good revenue inflow from that angle. In terms of expenditure, the government needs to free up resources. By cutting down the cost of governance. A lot of talks have been done around this over the last couple of months. Adoption of digital infrastructure in the MDAs and also tackling the issue of corruption. And lastly, in terms of capital projects, we know that many developing countries like to borrow funds in order to drive infrastructure projects in their economies. Since infrastructure requires large finance, we believe that the FG can adopt alternative financing methods, such as the BOT model, which is the build, operate, and transfer model. And this model has been successful in countries like China, India, Ethiopia, and even the case of Nigeria, because this model was what was used to build the Ibadan-Lagos Expressway as well as Lekki Toll Plaza. So there are a lot of alternative financing methods that the government could also look into in order to drive infrastructure, rather than going to the debt market immediately. And lastly, the Nigerian government will be encouraged to save more in terms of reserve. Nigeria has about $2.5 billion in its sovereign wealth fund, while a country like Kuwait that has less than 20 million citizens has about $750 billion in its life after oil fund. So funds like this help you to absorb shocks whenever there are national crises or whenever there are external vulnerabilities. So the country will not necessarily have to continue to accumulate debt.
All right, interesting. But the report also indicated that interest payments on Ways and Means was at 480 billion naira as at May. What's your take on this?
So It is expected because lately we've been observing that the CBN has been acting at the last resort to the federal government lately by providing ways and means to the government. And then in 2020 that really happened a lot because Nigeria could not tap into the external debt market. So the CBN was more of like the major supply aside from the money that was raised from the local debt market. So it is expected that since the government was able to accumulate a lot of debt from the CBN in 2020, interest payment is also expected to rise. And we are likely going to see that trend continue over the next couple of months. And trends like this would obviously affect our bottom lines because that way, when you pay a lot of money on interest, you have little or no money to finance capital projects. You have little or no money to take care of recurrent expenditure, and you have little or no money to drive the required change and growth that Nigeria is expected to do over the short to mid term.
Now, should we say is a situation now that a nation is debt trapped?
I wouldn't say we're in a debt trap yet because, looking at international standards for developing country, the IMF has signaled that a debt to GDP ratio of 25% is a good benchmark for developing countries. And currently, as we speak, Nigeria's debt to GDP ratio is around 21.3%. So we are still doing comfortably well in terms of debt profile. Well, I think the major issue lies with our debt servicing cost. When you compare the amount of money we generate as revenue and then the amount of money we pay out as debt service, debt interest, basically, that is where the issue actually lies because that model we run is not, sustainable because what it will just, at the end of the day, what it will make the country continue to borrow more because our fiscal deficit will continue to expand, given the fact that the government does not have resources to take care of projects like I've mentioned. So our fiscal deficit will continue to expand. And then the government in the next 2-3 years will be exposed to further borrowing, both in the international market and in the local market. And then at the end of the day, the issue of debt trap may now begin to arise. But currently, as we speak now, our debt profile is still quite okay when compared to our peers in the emerging markets and also in the BRICS region.
All right, but with a potential third wave of COVID-19 in sight and economies trying to spend their way, through the crisis and drive towards global vaccination, how do you see this impacting Nigeria's debt profile?
Largely, I think it will affect our debt profile negatively because in an instance where the government is forced to adopt another lockdown, economic activities may come to a total halt, and then the significant recovery we've seen in the fourth quarter of 2020 and first quarter of 2021 might actually get eroded. And then, the government might be forced to, expose themselves to external debt, like I've mentioned, because if we have a third wave of COVID-19 pandemic in SSA, it will largely affect commodities prices, yes. And obviously, oil may not be completely left out of that scenario. And if we're having any major shortfall or in oil prices, and and coupled with the fact that Nigeria is not producing oil at a very comfortable level, that might be a double whammy effect, and then the country may eventually lose out on its revenue generation. I mean, historically, our revenue generation has been poor, and if we continue to have that kind of trend, coupled with the third wave COVID-19 pandemic, it may even become even worse, and then the government will be forced to tap into the debt market. And what we might see in the local fixed income space is that if the government should increase its aggressiveness in that space, yields may be forced to rise for that because recently we've seen a recent drop down in fixed income yields. That the aggressiveness from the government may lead to a rise in yields in the local environment, and that may not be so friendly for investment managers who are actually going long.
Thank you very much, Babajide, for your time this morning with us. We do appreciate it.
Thank you very much.
And after the break, FX commodities market is next. Do stay with us.